So to expand on what is meant by values-aligned investment pools, specifically here we're talking about the long-term and moderate-term ESG pools. And the ESG pools are utilizing strategies, right, that take into account environmental, social, and corporate governance considerations. This approach are really, offering ESG pools to the Federation's funders provides the opportunity for funders to allocate capital in a way that has a positive impact really on these three different areas. Market returns are the single biggest determinant for performance of the Federation's investment pools. I'm going to cover a few asset classes here, starting with global stocks, which is towards the top of the chart here. It's the second to top row. Global stocks, which really is a combination of U.S. large cap stocks, international large cap stocks, and emerging markets, registered very strong returns for 2021. They were up 18.5%. There were disparity in returns across asset classes. So looking underneath the hood of global stocks, U.S. large cap stocks were up 28.7%, followed by international large cap stocks, which were up 11.3%. And then emerging market stocks at the bottom of this chart were actually declined 2.5% over the 1 year period amid economic challenges coming out of China. U.S. investment grade bonds really it's an important asset class because both the long-term and moderate-term pool have sizable allocations to varying degrees. But U.S. investment grade bonds really represents fixed income, broadly speaking, as interest rates headed higher over 2021. That detracted from bond returns, and bond returns returned negative 1.5% for the year. Okay, so the long-term DAF pools, and I'm going to draw your attention to the top part of this slide here. The long-term ESG pool is on the left side. The long-term passive pool is on the right side. And then there's various colors that correspond to different time periods. The green bar corresponds to 1 year returns. The blue bars correspond to 3 year returns, orange to 5 years, and gray to 7 years. I think the big takeaway here is that returns have been robust and consistent with what we've seen across stock markets. Pretty much across all the time periods, returns have been in the high single digits to low to mid double digits. If we look at the bottom part of the slide here, this is the asset allocation. The asset allocation corresponds with the time horizon of these two pools. And you'll recall that these two pools are really designed for long-term philanthropic capital. So the asset allocation for both of the pools, 70% is allocated to stocks, and then the balance, or 30%, is allocated to bonds. One other dynamic that I would be remiss in not calling out is that the long-term ESG pool over the short term has underperformed the long-term passive pool. The long-term ESG pool is structurally underweight energy. Energy over the past year and a half has been one of the strongest performing sectors. And in those types of environments, we expect the long-term ESG pool to underperform. We don't have any concerns about performance. Relative performance between the two pools is going to fluctuate. Sometimes sectors like energy are going to be in favor, or sometimes they're going to be out of favor. But based on really exhaustive research, we really believe that over a full market cycle, long-term, or I should say ESG performance is going to be competitive with its counterpart of non-ESG strategies. Maybe we want to go to the next slide that talks about the moderate term and short term pools. Again, the top part of the slide here, I'm going to draw your attention to, there's really three sections here. The first two sections, the section on the left and the middle section, that's titled moderate term pools. Moderate term ESG pool and the moderate term passive pool. Strong performance across pretty much all of the time periods. Albeit moderate performance compared to the long-term pools, The moderate term pools are designed to be more conservative relative to the long-term pools. These pools are really designed for funders with a time horizon in the range of 2 to 5 years. So the asset allocation, as you can see on the bottom here, is going to be more skewed towards conservative asset classes like bonds. So 35% of these two pools are made up of stocks, and then the balance, or 65%, the majority of these pools are actually made up of bonds. But going back to performance, over all the time periods, mid single digits to low double digits, particularly over the 3-year period for the moderate term passive pool. And then lastly is the short-term pool, which is on the far right side of the slide here. The short-term pool is really designed for donors that have a shorter term time horizon, really less than 2 years. You'll notice from the pie chart on the bottom, 100% of the pool is made up of money market securities. So really capital preservation first and foremost. So you're giving up return for security. And as you can see, the short-term pool returns over pretty much all the time periods have been in the range of 1%.
Thanks, Neil. So, hello, everyone. I wanted to circle back just quickly to the title of the webinar today, which is Investing Your Donor Advised Fund Capital for Good. And Neil just provided you some details around the financial good that your DAF assets are experiencing, but I'm going to provide you some meaningful and measurable ESG, or going back to that environmental, social, and governance good, or outcomes that come alongside that financial return. And I think it's important to mention that the Federation's focus and implementation of ESG is really very consistent with industry trends that have really picked up some steam here over the last decade. And as more and more institutions are really focused on alignment of their values or their missions with their investments to help boost their non-financial returns, or good, as I'm kind of referring to it now. So what are these measurable ESG goods? And Christina, if you wouldn't mind going to the next slide. These ESG goods or outcomes that I keep speaking about, here's a sampling of really 3 of the specific outcomes that we've been measuring within the pools to provide funders indication of those non-financial impact that your assets ultimately are supporting. The Federation has been very intentional about partnering with investment managers that are leading the industry in terms of their ESG strategy, which has translated into very high ESG scores for both of the pools, the long-term and the moderate. Additionally, these investment managers are investing in companies that are doing good by achieving direct sustainable impact at more than 2.5 times that of the market. And then last, they're also leaning in towards companies that can be viewed as cleaner, as measured by their CO2 emissions. So to fully illustrate those last 2 outcomes, because I know it can kind of be a little challenging in terms of some of those metrics that I just described, but we wanted to show you and measure that good that the companies are doing. And how we did that was by quantifying the amount of revenue that the pool's investments have derived from activities related to solving the world's major social and environmental challenges, which, as I mentioned earlier, is about 2.5 times more than the broader market, or standing right at about that 10% of direct revenue exposure. Secondly, the pools are also seeking to avoid the bad. So specifically when I speak about bad, they're avoiding fossil fuel emitting companies and channeling a lot of that capital to companies that are focused on renewables. So therefore, the companies held within the pools are emitting meaningfully less carbon than the broader market, as we've measured again here by those CO2 emissions. Now, we know that these are just a few ways that we are using to gauge, again, those non-financial successes within an impact within the pools. And we realize that there's much more impact and other ways to further align these pools to achieve within the investment pools. And we will continue to focus on these themes as well as some new ones over the short intermediate term. And I would like to hand it over to Texas right now to provide you a little bit of forward guidance on and details on those themes.
Thanks, Corey. So on this slide here, we show 8 themes that are really top considerations that we have been working with globally for our entire client base that are endowments and foundations, of just things to think about and things to maybe prepare for. Things like theme number 1, emphasizing inflation protection. We all know that inflation is higher. We see that in the headlines. Do we think it's sustained? Well, maybe not necessarily. But that it could have an effect on portfolios, in particular bonds, and there may be some ways to help protect on the downside if there is higher inflation and higher rates. So that's one of the sort of short-term tactical things. There are other things like that are much more strategic and maybe mission aligned, like themes 2, 3, and 4, incorporating diversity, equity, and inclusion, statistics, benchmarking, baselining, and then improvement in the use of managers that have teams and ownerships that are more diverse than we currently have. That's something that I think the entire industry is going through. 3 and 4 are related. Investing with impact. We'll be hearing more about impact a little today. So that is already something the Federation has. And then just looking at climate transition, the world is in a state of transitioning away from carbon intensive energy, and that presents a lot of risks and opportunities. So, I think those top 4 cover everything from shorter term things to some mission aligned things. At the bottom are maybe more defensive things. In the middle, there's 6 and 7 around the role of fixed income and rethinking diversification on how to make more robust portfolios as markets get more volatile. But then on the 2 ends, items 5 and 8 are around just broader changes going on here. And number 5, embrace disruption. We all know that COVID for the last 2 years now has disrupted so many ways of working, so many ways of living, and that's creating some investment risks and opportunities. And then on the far right-hand side, reassessing sort of China exposure as a market as much as a risk politically and for other reasons.